Hycroft Mining Holding Corporation is currently trading at $25.86 per share, representing a massive intraday surge of $9.44 or 57.49% as we move through the session on December 22, 2025. This isn't just a minor fluctuation in a volatile sector, it is a full-scale vertical breakout that has caught even the most seasoned precious metals analysts by surprise. While the broader market might be fixated on the usual tech giants like Tesla stock or Nvidia stock, those monitoring the commodity space are witnessing a total reassessment of what this Nevada-based miner is actually worth. The immediate insight that most people are missing here is that Hycroft has effectively transitioned from being a distressed asset to a debt-free exploration powerhouse with some of the highest silver grades ever recorded in its history. The expectation for a junior miner like this is usually a slow grind of dilution and constant capital raises that eat away at shareholder value. The reality, however, is that Hycroft has managed to eliminate its debt entirely while concurrently hitting massive intercepts in their Vortex system. We are seeing intercepts like 26.4 meters at 565.31 grams per ton of silver. To put that in perspective, many mines operate profitably on a fraction of that grade. This contrast between the penny stock reputation and the high-grade discovery reality is exactly why the price is detaching from its previous range. Common ground suggests that most retail investors viewing this on a Robinhood app or through their SoFi trading platform might think this is just another meme-driven spike, perhaps a remnant of the attention the company received when AMC Entertainment first bought in. However, the contrarian view, and the one that the data seems to support, is that we are looking at a fundamental shift in the asset's quality. This isn't just about retail hype, it's about institutional-grade discovery. While many individual brokerage accounts were focused on the volatility of Apple stock, the smart capital was watching Eric Sprott, who now holds a staggering 42.1% stake in the company. When a billionaire mining legend like Sprott aggressively increases his position to over 36 million shares, it signals that the value in the ground is far exceeding the value reflected on the ticker. We are seeing a massive increase in volume today, with over 13 million shares changing hands, which is a huge departure from the average volume. This indicates that we aren't just seeing small trades on a mobile app, we are seeing significant accumulation. The recent movement is being fueled by a perfect storm of internal success and macroeconomic tailwinds. As of today, gold has surged past the $4,400 per ounce mark, and silver has hit a record high of $69 per ounce. In an environment where precious metals are hitting all-time highs, a company like Hycroft, which sits on one of the largest deposits in North America, becomes a massive lever for investors seeking exposure. If you are using interactive brokers trading tools or checking your Fidelity mobile app, you'll notice that the technical indicators for HYMC have moved into extreme overbought territory, with an RSI hitting 73.7. Yet the momentum persists because the drill results are confirming that the high-grade silver systems at Vortex and Brimstone are larger and more consistent than previously modeled. The latest results from hole H25D-6072 showed 26.4 meters at 565.31 grams per ton of silver, which included a section grading over 800 grams per ton. This confirms that the mineralization is expanding to the west and remains open in all directions. For those doing their own self-investing, these numbers are hard to ignore because they fundamentally change the economics of the future milling operation. While much of the market is looking for investment help with diversified products like Schwab Intelligent Portfolios or various Fidelity mutual funds, the aggressive traders are flocking to HYMC because of its unique position. Unlike many other miners that are struggling with rising costs and debt, Hycroft announced earlier this year that it has eliminated all its debt. By raising capital through strategic offerings and using those funds to prepay $136 million in indebtedness, the company has cleared its balance sheet. This gives them a massive runway to continue their 14,500-meter core drilling program without the constant threat of a liquidity crisis. When you look at your portfolio on a Fidelity trading platform or a Robinhood stock trading interface, the debt-free status of a junior miner is perhaps the most underrated metric. It removes the bankruptcy risk that usually plagues companies at this stage, allowing the market to focus purely on the resource potential. To understand why this is happening now, we have to look at what Hycroft actually is. The company owns the Hycroft mine in northern Nevada, a Tier 1 mining jurisdiction. It is a massive land package of over 64,000 acres, and incredibly, less than 10% of that has been explored. For decades, it was operated as an oxide heap leach mine, but the future of the company lies in its sulfide ore. They are currently transitioning into a large-scale milling operation. This transition is usually a high-risk period for a company, but the discovery of these high-grade silver systems has provided a cushion. The Vortex and Brimstone systems were discovered only recently, and they represent a significant value driver that wasn't in the original mine plan. This is the reality that is exceeding the expectation of a simple sulfide transition. Investors who might have been looking for online investing options and stumbled upon Hycroft a year ago would have seen a company struggling with a massive resource but no clear way to get it out of the ground profitably. Today, they see a company with $175 million in cash, no debt, and record-breaking silver grades. Comment below how many shares of HYMC you currently hold, or if you are planning to enter at these new 52-week highs. Institutional activity has been equally fascinating. While AMC Entertainment recently trimmed its stake, that equity wasn't dumped onto the open market. It was transferred to Sprott Mining for over $24 million. This move consolidated the ownership into the hands of a mining specialist rather than a theater chain, which the market has interpreted as a professional endorsement of the mine's technical feasibility. If you are examining this through a Fidelity brokerage account or using Interactive Brokers' fees as a baseline for your trading costs, you have to consider the long-term implications of this ownership structure. Having a single, highly sophisticated investor owning nearly half the company reduces the float and can lead to these types of explosive price movements when positive news hits. The lack of selling pressure from insiders and the aggressive buying from the top owner creates a supply-demand imbalance that favors the bulls. Looking ahead, the tension between expectation and reality will continue to center on the 2026 resource update and the subsequent technical reports. The market expects that these high-grade results will eventually lead to a viable mine plan, but the reality will depend on the metallurgical recoveries from the sulfide ore. The company has already reported positive test work using flotation methods, showing that they can achieve meaningful recoveries. As they continue to add rigs to the site, planning for 4 rigs in 2026, the flow of assay results will be the primary catalyst. If the grades continue to hold or improve as they move deeper into the Vortex system, the current $25 price point might actually look conservative. However, the risk remains that the capital required to build the actual mill will be significant. Even with $175 million in the bank, building a world-class processing facility in Nevada can cost hundreds of millions of dollars. This is where the next expectation versus reality battle will be fought. Will they find a partner, or will they take on new debt to build it themselves? For the average person looking for the best investing sites or using a SoFi robo-advisor, HYMC might seem too volatile. It has a beta of 2.72, meaning it moves nearly 3 times as much as the broader market. But for those who use a Fidelity trading platform or Robinhood investments to find high growth opportunities, this is the definition of a high reward play. It is a bet on the price of gold and silver as much as it is a bet on the geology of Nevada. The fact that the stock has surged over 700% in a year while the company is still in the exploration phase tells you everything you need to know about the market's appetite for tangible assets. In a world of digital currencies and AI hype, there is something remarkably grounding about a company that owns millions of ounces of physical gold and physical silver in a stable jurisdiction. The central insight here is that the market is finally pricing in the what-if scenario. What if Hycroft isn't just a large, low-grade deposit, but a massive deposit with a high-grade heart? The drill results from the 2025 program suggest the latter. By removing the debt and securing the backing of Eric Sprott, the company has de-risked the failure scenario significantly. As you manage your individual brokerage account, whether it's through Fidelity Wealth Management or a self-directed Robinhood app, you have to weigh this newfound stability against the parabolic price move we're seeing today. Is the 57.49% jump a blow-off top or the start of a new valuation regime? Given that silver is hitting $69 an ounce, it's hard to argue that the underlying asset isn't worth more today than it was yesterday. In summary, the contrast between the old Hycroft, a debt-laden,